two clients that I came across. One of them was self-employed, the other was PAYE. Now I've changed their names for the purposes of I suppose today's session, but just to give you kind of a quick example of how individuals can reduce the tax that they pay. The guy John, 36 years of age, basically had a tax bill pending. And for people who are self-employed who might be on this call, basically the way it works is that you have to pay your final tax for the previous year and your preliminary tax for the coming year. And typically what I'm going to suggest is that you can reduce those tax bills very simply. An example that I've put up on the slide here is that in the example of someone who has a bill of say 14,000 euros, which could be made up of the final bill for last year and the bill for this coming year, one of the opportunities they have is to pay money into a fund. Okay, I'm going to talk a little bit more about this. For the POE worker who's earning 50,000 a year, they also have an opportunity to pay into the fund. Just for anyone who just noticed who might have some background noise, if you could just make sure that your mic's on mute. And as I say, if anyone does have any questions, please feel free to throw them into the chat and we will answer them. So just to move on from that, how could they do this? Well, John took my advice and put 10,000 euros into this fund. And by doing so, he reduced his last year's bill by 4,000. But by doing that, also reduced his preliminary bill by 4,000. So in essence, by him making a 10,000 investment, he was able to reduce his tax by 8,000 euros. The amount of cost to him was 16,000 versus the 14,000 bill. But the key thing for John is that he now has 10,000 euros to show for that. It's a massive return on investment. For Sarah, who on 50,000 a year was paying about 12,000 at the high rate of tax, my advice to her was to make a contribution into this fund, of which she put 9,000 euros as a lump sum and started 500 a month, which was for October and for the start of November, hence a 10,000 euros contribution. And what that did was that they gave her 4,000 euros back of tax relief, where for the net cost of 6,000, she now has 10,000 euros in this fund. Okay. Some of you can probably guess what this fund is, and this fund is a pension. In my opinion, pensions are totally underutilized in the Irish marketplace. Just thrown up some things that people have said about pensions. Some people feel that they're too young to start a pension. Some people feel that they're too old. There is no time frame of which people should put money into a pension scheme. The examples that I've given you, and these equally apply to business owners, it is a massive opportunity to reduce the tax that you pay. And as well as that, the pension fund itself grows tax-free. Now, I'm not going to preach the gospel today. What I want to do is make sure that everyone that's on this call is aware of what the opportunity is, where they are in their pension financial cycle, and are they doing the best that they can with the resources they have available. So the starting point really is that a lot of clients I speak to, they don't know what their pension scheme is likely to provide them. And what I really like to identify with people is, let's put a financial roadmap in place. It's very simple. The key things I always ask people are, do you know what your pension fund is worth at the moment? Now, you may have some pension schemes from previous employments, and all I'd say to you is that these can kind of be amalgamated into one. What is the overall sum? Do you know what level of contributions are being made into the pension? Are you in a company pension arrangement with a company that is making contributions on your behalf and you're making a contribution yourself? And do you know what that pension is likely to be worth at the time that you'll be looking to draw it down? It might be at 60, it might be at 65, it might be at 50. There is no fixed age to when you can draw down this benefit. The key thing to know is that you at least have a little bit of a roadmap. Now, with regards to pension funds, and there's a lot of, I suppose, misunderstanding, or people don't necessarily know exactly how these things work. And all I'd say to you is that a pension fund is really just a long-term savings plan, but it's a savings plan on steroids. It has great tax benefits going in. Generally speaking, 40% is the amount that you'll get back either at source, if it's paid directly from your employer, or by salary deduction, or by way of a tax claim, which can be done very easily, and we can help clients with this. The other thing to understand is that you are likely to be entitled to the state pension. Now, there's a lot of talk at the moment, and obviously we have the budget next Tuesday, which will go into a little bit about what might happen to the state benefit. Will it be extended beyond 67, which is the current age of which people can draw this benefit down? But for those of you that may be aware, that amount is about 12,000 a year. And there's not a lot of people that can afford to live on that. Hence why I would encourage individuals to make contributions towards their own company pension, or indeed make sure that they are making private provisions. For those of you that have just joined, I'm just talking a little bit about, I suppose, the tax opportunity that pension allows individuals for. Whether you're in a company arrangement, whether you're self-employed, whether you're a POA person or a business owner, it's a massive opportunity, in my opinion. There will be a playback on this webinar, so for anyone who has missed the first few minutes, we will send out the video and you can listen back to it. And myself and David Looney, who are available to take any questions, but indeed we're offering a 30-minute consultation completely free of charge, without obligation, just to assist people. And the key thing I want everyone to take from today is that you can get simple advice without it costing you anything, where you know where you stand in terms of your pension scheme or schemes and what they're likely to benefit you by, and why you should seriously consider making provisions more so than you probably are. A lot of people aren't aware that regardless, depending on your age, you have massive opportunity to get this tax back from revenue. So again, I described Sarah, who was earning 50,000 a year. If Sarah was in her mid 30s, she can put 20% of her salary into a pension scheme, and that's excluding her employer's contribution. Now, some people might think and say, Christ, that's 10,000 a year, 20% of 50,000. Sure, no one's going to be able to afford to put that in. But the key thing for Sarah is that she was getting 4,000 euros back immediately. So it was only costing her 6,000 euros. Now, again, it depends on everyone's situation as to what they can afford. And all I'd say is that versus leaving money in the bank, which is going to earn 0% for you, or versus putting money into some sort of savings vehicle where you're not going to get any real return on your savings, it's a huge opportunity for you to get a tax reduction, but also to see the growth of your pension tax-free. With regards to the things that you should be looking to find out, if you don't know already, are if you're part of a pension scheme through another advisor or through a company, what are the charges that you're paying? People are sometimes a little bit loose about the fact that, you know, they may not be aware of what fees they suffer. Now, the reason why I'm saying this is because it will have a massive bearing on the returns that you'll achieve. We've seen situations where some clients are getting only 95% of what they contribute put into the fund, or some people are paying management fees in excess of 2% a year. Extraordinary stuff. And all I'd like to leave you with today is that you shouldn't be having any of your initial investment reduced, and that your management fee should be no more than 1.25%. So it's important just to find out, or get an advisor like us to help you assess what they are. The key thing that we always do for people is that we ensure that they don't have to go to a lot of hassle. People have this impression that, you know, looking at finance, it's really challenging and difficult and takes a lot of time, and it doesn't really. The only thing we ever say to people is, if you wish us to look into your plans for you without any cost or obligation, and indeed no bias, because those of you that have a company pension, we can't do anything but advise you, but we can certainly assist you with no drama. Typically, by signing authorization, it would allow us to go to the insurance company, whether it be Irish Life or Mercer or Aon Hewitt, and find out the information on your behalf and then present it to you. The next thing that I think people should be aware of is, where is their money invested? If you're part of a company scheme, and if you're with Irish Life, or if you're with Mercer or Zurich, do you know what funds you're invested in? The key thing that I want to, I suppose, emphasize today is that not all funds are the same, and that you should really be in a fund that's commensurate to your age and the term to your retirement. So for example, Sarah, who was in her mid-30s, she should be in a high risk fund because she has at least 20 plus years until such a time that she wants to draw the benefit. Whereas if someone's in their mid 50s, their appetite for risk and their desire to take risk should be lessened, because the time in which they have for the funds to perform and indeed to recover from any lack of performance is obviously shorter. Okay, so again, just a takeaway from today is, the longer your time horizon, the more risk that you should be prepared to accept. And anyone who is risk averse, and I come across them all the time, I would challenge you and say, there is no sense in you leaving money in cash. Cash will earn you nothing. If anything, you will lose money because you will be paying a management fee and not making a return. And more importantly, is you won't even keep pace with inflation. Now, risk and reward are related, and you do not have to always take high risk, particularly if you're looking at shorter term investments. I've shown an example here on the slide. Zurich, who are one of our favorite insurance companies when it comes to pensions, they have a range of different funds in different risk categories. So for example, somebody who is nearing retirement and wants to take it a bit more conservatively, they can go into a fund in, say, a risk level 2. Risk typically works on a scale of 1 to 7, 1 being no risk, 7 being high. However, myself personally, I'm 47 years of age. I'm in a risk level 5 fund, a fund called Prisma 5. Why? Because I have at least 10 years plus to retirement, and I'm prepared to accept the risk that that fund carries. Typically speaking, it is on a plus minus of about 10 to 12% per annum. Now, the chart that I'm showing you here would indicate that over the last 5 years, the annualized returns for that fund have been about 12% a year, which is fairly remarkable given that we've been in a 0% interest rate environment for the last couple of years, and we're probably likely to be so, particularly if you take account of COVID and Brexit having happened in that period. Now, the other thing is, and I mentioned this earlier, do you know what your pensions are worth, how much is going in per month, and what the value is likely to be? And they're the 3 things that I absolutely adhere to people that they should be aware of. And if you are not, and if you'd like us to help you ascertain the answers to those 3 things, please endeavor to get onto myself or David, and we'll happily do that for you without any hassle at all. For those of you that may have pensions from previous employments, I think it's really important to find out what they're worth, where they're invested, and what your options are. Generally speaking, again, it's very simple for us to assist clients in, making the right decisions. You might be able to access that money now. Anyone who turns 50 years of age typically will have access to any ex-employer pensions. That might be very useful, particularly if you are looking to move house, for example, or if you're looking to pay for something that you don't necessarily want to go to the bank with, may even pay down a mortgage. These are things that we suggest people should explore and look into in more detail. Here's another business case study. Business owner like myself, this particular chap, he turned 50, married, fairly decent business. Company is 15 years, and he's not looked at his pension, and he's looking at his NRA, which is a bit of jargon. It's his natural retirement age of 65. And what I showed him is that he hadn't made any provisions towards pensions, but he could fund for about 5,000 euros a month, and he'd be able to build up a fund tax-free where he hasn't paid any employer's PRSI or any tax on those payments, of a fund of 1.12 million at a very conservative growth rate. And that would be him getting money out of his business in the most tax efficient manner possible. And he wasn't aware of that. And the key thing is to understand why it makes sense for people to look at these provisions. I just want to move on to another tax saving vehicle. This is different to pensions, but it's equally applicable to anybody who's suffering tax at the higher rate, whether you have rental income, whether you have employment income from one or several sources. And basically, it's a revenue-backed scheme called the Employment Investment Incentive Scheme. For those of you that would have listened to this call, webinars that I've done previously, you would have heard me talk about this tax scheme. You will see advertised in the Sunday newspapers pretty much for the next 2 months. If anyone picks up any of the Sunday papers this Sunday, I'm certain that you'll see some companies advertising under this scheme. Basically, the way it works is that if you put an investment amount, and I'm going to use an example of 10,000 euros that you must have personally into one of these qualifying companies, you will get 4,000 euros back within the next 6 months from revenue. At the end of the 4-year term, you look to achieve your 10,000 euros plus a return of your investment, typically about 20%. So the simple maths are you invest 10,000 less 4, and you're looking to get back your 12,000 euros. It's a double your money investment. Now, people may scorn this and say, well, hang on, it sounds a bit too good to be true. It's not. It's absolutely as I've described it. What you do need to be aware of is that there is risk involved. And the risk is that the company that you lend this money to is in a position to pay you back. Our role as independent financial advisors is to ensure that we select the best companies in the marketplace. And there's roughly about 50 to 70 companies every year since 2011 that have been qualifying under the scheme, that we give you the examples of the companies that we feel very strongly about, and that you would be able to research, read the literature, and give yourself comfort that they make sense. We've been promoting 2 companies this year, primarily an IT company called MX and a whiskey company called Kinsale Spirit. Now, I can send on information to anyone who is interested. These 2 companies have grown during COVID. They have fabulous people working for them, really good business owners that are very adaptable to the changing environment. And they're companies that I believe are well positioned to grow in the next 4 years, hence why we would recommend them to our clients. The next area that I'd like to focus on is savings. So while this is not, I suppose, directly about reducing the tax that you pay, it is about trying to provide a return on investment to individuals. So I say to people all the time, you know, describe to me your situation in terms of like, do you have monies in the bank? Are you accumulating funds in, say, the credit union or the post office? Are you getting any return for your savings, which in those institutions is blatantly no. Now, the key thing we always say to people is that you need to be aware of the fact that there are alternatives available. We launched the Savings and Investment Club about 6 months ago, and I think it's a fantastic, I suppose, vehicle for people to save regularly or indeed put a lump sum of monies in, where it allows them some freedoms, one of which is that they can access the money at all times without penalty, and the other is that they got total freedom of payment. They can pay in a monthly amount, which starts at 100 euros a month, or a lump sum of 5,000, and they can stop it at any stage. They can increase it, they can reduce it, and they can take money out as and when they require monies. I think it's a no-brainer for everyone. I really do. Whether you're saving for your kids' education monies, whether you're saving for a new property, whether you're saving for your first house, the one thing I would say is that you need to give these things time. Whilst they're completely accessible, there is no point saving into these vehicles for 6 months. It's just too short a time frame. And as I said earlier, and for those of you that missed the earlier part of this webinar, is that you should be prepared to accept a bit more risk the longer that you are looking to invest for. So for anyone who is looking at a 5-year plus horizon, I would strongly suggest that on that risk scale of 1 to 7 that I described, you should be looking at around the medium risk level, which is a 4, typically looking at earning about 5% per year. That's the objective what I set out for all of my clients as a return on investment. And if you compare that to what the banks and post office and credit unions will pay you, I think it's a significant return. Yes, it's not guaranteed, and yes, there is a certain element of risk, but the risk is typically about 5% on the downside. And what I say to people is, if you are saving monthly, it reduces the risk that you suffer because you are paying over a 12-month increment. So hence why I feel very strongly that there is no sense in anyone, particularly if you have kids that you're saving for, to leave the money in the banks knowing that you're not going to make any money, certainly not for the next 3 to 4 years. I just want to leave you with one or two more kind of final takeaways. A lot of us worked from home last year. If you haven't already done so, I would strongly encourage you to claim back 10% of the bills that you suffered, typically things like broadband, heating, electricity, and whether you have absolutely no issue with people doing that, you do not need to provide receipts, although I do suggest that you keep them for 4 years because that's the period of which they can go back. And just go onto the Ross system and make a claim. The average claim that people made last year was about 132 euros. I have seen some quite a bit higher than that. And again, we can assist you in the process of how to do that. We don't charge for this. We have no bias, but it's a really simple thing for people. And I'd encourage you to do the same thing in January next year for the time that you spent at home in 2021, i.e. this year. There are lots of other things that people can claim for. Medical expenses is another one. I find a lot of people tend not to do that, and I would encourage you to ensure that you are claiming back on your medical expenses. Some people are not aware, but you can claim for certain reliefs on third level education. There are also other reliefs, and if anyone's not sure about whether they are making sufficient claims, please do feel free to reach out to us. In terms of your employment, there are one or two other things that we do speak to clients about that I suppose I feel very importantly about. And the final thing I want to leave you with today is that the key thing for me as a financial planner is to ensure that people make necessary provisions. Financial planning is about balance. And I always say to people, have you covered off certain aspects of your finances? Are you saving for your retirement? Are you saving for your children's education? Are you ensuring that you're not overspending? And it's about making sure that you've got several pots working for you. The key thing is to ensure that your income, which is likely to be your largest asset, most individuals listen to this call will earn over €1 million during the course of their lifetime, that you are not going to suffer in the event of being unable to work through illness, ill health, and so on. Some of you may have this protected through your employment, and if so, I personally feel that that's sufficient, but some of you may not necessarily have this cover in place. And the key thing I say to people is just don't let ignorance be bliss for you. You need to look into, okay, well, what can I insure for? And more importantly, how much will it cost me? The one advantage of this type of policy is that it is eligible for tax relief. So for example, somebody who is suffering tax at the higher rate can get relief at 40%. But again, David and myself would happily give you some guidance on this if you would like us to. The final thing I just want to touch on, and this is not for today, but I'm going to be doing a webinar on the 20th of October around this area. It's all about, I suppose, environmentally friendly investing, ESG, which is what it's known as, which is environmental, social, and governance responsible companies. And it's really about giving you some guidance as to the next approach. This doesn't mean for anyone who's saving with us currently that they need to change their strategy, but we will be implementing some changes going forward. I think it's going to be a huge area, not because necessarily I'm massively inclined about the environment. I am, but what I am inclined about is opportunities for our clients to make the best returns that they can. It just so happens that it is also leading into that, and I'm sure many of you have seen a big impetus between companies that are more focused on their, I suppose, carbon scenario, and indeed making opportunity where they see fit. And our role as advisors is really just to explore this with our clients, give them the opportunity and give them the best options available. So I just want to finish off and say I do appreciate your time. We will be doing further webinars. David, my colleague, is doing another webinar on the 5th of November on mortgages, which I think will be a fantastic Q&A session. So please do look out for that. And